In the early 20th century, governments made a decision that seemed entirely logical at the time. They would fund the costs of modern society by taxing the thing that produced most of its wealth, human labor. Income taxes, payroll contributions, social insurance premiums, all of these instruments rest on the same foundational assumption. People work, and work generates income. The state takes a share of that income and uses it to maintain the conditions under which more work becomes possible. For most of the last century, this tax architecture held. It was not perfect, but it was coherent. The assumptions beneath it matched the reality it was taxing. Those assumptions are now breaking down faster than almost any government has publicly acknowledged. When a firm replaces a team of analysts with an AI system, something very precise happens to the public finances. Income tax contributions stop. Social insurance payments stop. Employer payroll contributions stop. The consumption taxes generated by those workers spending their wages on housing, food, and transport weaken as their purchasing power disappears from the local economy. The AI system that replaced them generates almost none of these fiscal events. It consumes electricity, which is taxed modestly. It requires maintenance from a small number of highly skilled people. The firm's profits may rise, and corporation tax captures some of that, but at rates that have been systematically eroded over decades of international tax competition. The net result is a transfer of productive activity from a heavily taxed category to a lightly taxed one. At small scale, this is a rounding error. At the scale AI adoption is projected to reach within a decade, it becomes a structural crisis. There is a subtler problem beneath the fiscal one, and it is in some ways more consequential. Taxation is not just a revenue mechanism, it is a price signal. When governments tax labor heavily and leave AI output largely untaxed, they make human workers more expensive relative to automated alternatives. Employers choosing to automate are not making irrational decisions. They are responding rationally to a signal the current tax architecture is sending. The signal says, human labor is expensive. AI labor is cheap. And the gap is growing every year. This is not a conspiracy. Nobody designed it this way. It is the accidental consequence of a tax system built for a world where AI did not exist, now operating in a world where it is replacing the very labor the system was built to tax. Here is the distinction that matters most for policy. Some of the displacement AI produces reflects genuine efficiency gains. AI genuinely does some tasks better, faster, and at lower true cost than human labor. That displacement is economically justified and probably beneficial in the long run. But some of the displacement reflects a tax distortion that makes AI appear cheaper than it actually is when the full social cost of that displacement is accounted for. That displacement is not an efficiency gain. It is a subsidy, paid for by the workers being displaced, through the erosion of the tax base that funds the services everyone depends on. The current system cannot tell the difference between the two. Designing policy that can is the most important fiscal challenge of the next decade. The idea of taxing automation is not new. Bill Gates proposed the robot tax in a widely reported interview. Various European parliaments discussed it. South Korea enacted a modified version that reduced automation tax deductions rather than introducing a new levy, and later partially reversed even that. The reason these proposals struggled was definitional. What counts as a robot? A spreadsheet formula, a fraud detection algorithm, a recommendation engine. Every serious attempt to draw the line between taxable automation and ordinary software collapsed at this point. There is, however, a more tractable approach. Rather than taxing the technology, you tax the outcome it produces at the expense of taxable human labor. A levy on corporate productivity gains above a defined threshold, calculated as the difference between revenue growth and labor cost growth adjusted for sector benchmarks, captures displacement rather than technology. Firms that grow revenue while maintaining or growing their human workforce pay nothing additional. Firms that grow revenue while shrinking their workforce relative to sector peers pay a levy on the gap. This design avoids the definitional trap of the robot tax entirely. It captures the displacement rather than the instrument, and creates an incentive structure that rewards firms for keeping humans in the loop where AI and human labor are genuinely substitutable. Combined with a token-based AI consumption tax, which is examined in detail in the next article in this series, this forms the outline of a fiscal architecture designed for the productive reality that is emerging. Every commercial AI transaction already generates a precise consumption log built into provider billing systems. The measurement infrastructure for taxing AI productive capacity exists by default. Next week, we examine exactly how that mechanism would work, where it falls short, and what it would take to implement it at European scale. There is a reason this conversation has not produced coherent policy in any major economy despite being clearly necessary. The firms benefiting most from the current tax distortion are among the most politically influential actors in every developed democracy. The technology companies building AI systems, the capital-intensive firms adopting them at scale, and the financial institutions funding both have strong organized interests in maintaining a tax architecture that systematically advantages their business models. The workers bearing the cost of this distortion are diffuse, increasingly precarious, and in many cases not yet aware that the erosion of their economic position is partly a function of tax architecture rather than purely technological inevitability. Naming it accurately is the first step toward changing it. The status quo is not neutral. It is actively redistributing the gains from AI productivity toward capital and away from labor, through a system that nobody designed to do this and almost nobody is publicly acknowledging is happening. The fiscal case for correcting this distortion must be structural, not ideological. The system we use to fund public life was built for a world where human labor was the primary engine of productivity. That world is ending, but the tax architecture has not noticed yet. Next week we examine the most technically tractable mechanism for closing the gap, a token-based AI productivity levy, why the measurement infrastructure already exists by default, and what a realistic path to implementation looks like across 3 stages. Subscribe to Future Work Society for weekly analysis on AI, automation, and what it means for the world we are building together.